I would now like to invite Mr. Ali Asghar Bhuriwala on stage to present on macroeconomic context for the insurance sector. Thank you.
Thank you, Mariam, and assalamu alaikum, everyone. Before I start, I just wanted to take 1 minute. Mariam mentioned that we've completed 11 years and it's our 10th annual conference. So I just wanted to thank two sets of people who have been with us on our journey. The first one, our esteemed clients, and it is good to see some of you who were there in the first conference in the room today as well, and for all the support that the clients have given us over the years to bring us to where we are. So thank you all for that. And the second group of people, obviously our employees, who have worked really hard and provided the level of service that has kept the clients happy to bring us to this stage. So a round of thanks for both these people. Thank you. I will look today at the macroeconomic context for the insurance sector. We start with a view on the first economic indicator always being the GDP. The GDP of UAE over the last 4 years has been in the range of 4 to 4.5%, and the expectation is to be in the range of 4.5 to 5% going forward. So this points towards a good expectation, and with the unemployment rate also going down, the prospect for insurance is good. The number in 2022 being high is because of the increase in the oil GDP, and if we come to this slide, we can see that there was a surge in the oil GDP for 2022, but UAE's reliance on oil GDP has been declining over the years as they push more focus towards the non-oil GDP part with things like trade, manufacturing, financial services, and tourism. So the non-oil GDP contributes roughly 70% plus of the GDP of UAE, and with the non-oil GDP also being stable, the prospects for both retail and personal line insurance seems very bright in the UAE. This is a purchase managers index that is another indication of the economic growth. So without going into too much details, a level over 50 indicates that the economy is primed for expansion. Below 50 means that the economy is contracting. So as you can see, post-COVID, UAE has maintained a value that is in excess of 50 and shows it is primed for growth. Some indicators like the growth of new car sales, and Mirza will delve more on that in his presentation, but 18% increase in car sales growth over the last 3 years, around 15% growth in tourism, and almost 37% growth in real estate transactions. A lot of money has been coming into Dubai, and this has boosted the overall real estate market as well. All of this obviously primes insurance as well. These are some of the plans for Vision 2031 that the government has. I will not go into too much detail on them, but doubling the GDP, doubling non-oil exports, increasing tourism and foreign trade, improving the Human Development Index to make UAE one of the top countries there and one of the best cities to live in. So these are some of the plans that the government has, and these are some things that all will boost overall macroeconomic growth and by default insurance. Coming specifically to insurance market indicators, the first thing obviously we look from an insurance context is around the density and penetration. So insurance density basically is the premium per capita, where what is the premium per member of the population. This is around 5,700 for 2024, which is much higher than the global average. We were just trying to contemplate why this would be. Obviously there are multiple reasons for that. One of them is that this market has mandatory health and motor insurance, and since everyone technically has health insurance, that obviously boosts up the numbers as compared to global averages. The other reason, which is kind of like a devil's advocate thing in this, is that the way the numbers for insurance premiums are booked in this market, because there's a lot of double counting when it comes to pooled schemes and FAC inverts, which are counted twice in the books of the writing company and the book of the company that it seeds it out to. Some of the premium numbers can hence be overstated. But we obviously do not get the breakdown of how exactly that happens, but based on the published numbers, the density of the premiums is higher than the global average. Penetrations remains lower than global average. This does not give the breakup of life and non-life, For non-life, the penetration is actually not very far off from the global numbers. It is the life part where the penetration is actually much lower than the world average. And Aman will cover this in his presentation, but there is a scope for life business also picking up in the UAE. If we quickly look at the growth of how the premiums have come around over the last 5 years, the premium growth has been steady from 44, 47, 53, 65. The growth has been quite significant. Most of this has been spurred by health insurance. We'll cover that in the next slide. The loss ratios had been pretty stable. 2024 obviously sees a spike on the gross side because of the huge flood event that we had, which led to like massive insured losses. If we look at the net premiums and the net profit margins have again fairly been stable. And the net profit margin, although has declined from 23, but the decline is not that, which means that most of the insured losses of 2024 floods were absorbed by reinsurance. So this gives a very high-level snapshot of the breakup of all lines of business. As I said, health accounts for almost half of the premiums for the market. The share for life and motor roughly in similar range, and a huge portion also obviously comes from commercial lines. This obviously is the gross numbers. On the net side, commercial lines are heavily reinsured out. So the share of health and motor on the net side becomes much larger. When we look at combined ratios, again, the industry has given fairly stable results over the last 5 years. If you look at it on a net basis, the combined ratios in the last 3 years have just been shy of the 100% benchmark. These obviously are from the CBU reports, and for the entire market, companies can have different levels of performance which affects them, but the net loss ratio has been in the range of around early 70% in the last 4 years. These are some of the flood events and other cat events that happened. Again, the biggest one last year about the rains and floods, which was like a 1 in a 75-year scenario. And that led to around estimated 8 billion of economic loss, out of which 3 billion was estimated as insured losses. This again Hasham will cover in his presentation, so I will not go into detail, but because of the losses, the market did respond by changing the reinsurance strategy, and Hasham will cover that in his slide in more detail. Investment yields have been fairly consistent, and total invested assets obviously growing over time, but investment yields have been fairly consistent around 6.5–7% over the last 3 years. Now we look at some of the indicators by line of business. I will not go into too much detail because we have separate sessions for both health, motor and life. But just to quickly say that the population is increasing, especially the working population is increasing. This will obviously lead to an increase in the requirement for health insurance, and that is already being seen. Health insurance business has grown significantly. If you look from 2021 till 2024, the market has almost increased by 50% in the last 4 years on gross written premium basis. Most of the premium does come from group. A very smaller portion comes from individual insurance. Loss ratios have been increasing, and there is a dip in 2024. So as the premiums have started to rise, and as companies have tried to shore that up, we have seen a dip in the gross loss ratios, especially from 23 to 24. The decrease from 83 to 75 on net is something that Naveen will delve on more in his presentation. But we have seen improvement on the medical side overall as compared to the last year. On motor, again, as I mentioned, there has been a very significant increase in car sales. And one of the biggest factors that we are seeing is the advent of Chinese vehicles in the market. So if you look at 2020, there was hardly any Chinese vehicle on the roads of Dubai. And now by new car sale distribution, there's almost 12% increase in Chinese vehicles on the road. And this number will keep increasing for 25 and onwards. So as you can see, again, this gives, I don't want to go into detail of this, Mirza will cover this, but yeah, Chinese vehicles have taken this market by storm. And I think 1 out of every 5–6 cars on the road you see nowadays are Chinese vehicles. For motor, again, the market has increased significantly from 2021. Over the last 1 year, post the floods, what has actually happened is, although this doesn't cover 2025 numbers, but after the floods of 2024, one good thing that happened was that all the companies made a concerted effort to increase the premium rates. So we saw a lot of price wars before that, and the pricing is still competitive, obviously, but we have seen an average increase rate of around 25 to 30% also in certain cases, from prices that were pre-flood level in 24 to what they are today. The year-on-year growth for motor has been high. Some of it is obviously because of the new vehicles, but a lot of it is also to do with the increase in the premium rates. The split of motor by line of business is there, and again Mirza will delve more on that, so I will not go into that detail. Loss ratios for 2024 obviously show a very high number because of the flood losses. These, if you neutralize the flood losses, would have been on like at par or slightly downwards. And 2025, the numbers are coming out to be much better. Moving on to commercial lines, again, there is a lot of mega projects that are driving the commercial lines business. And if you look at real estate transaction as one benchmark, increase in both the volume of transactions and the value of transactions has been seen in the last 5 years. And the growth has been across all lines of business in commercial lines, so it's not like restricted to one or the other. It has been across all lines of business. Again, the huge gap between the gross and net loss ratio of 2024 does indicate that the reinsurance did pick up the brunt of the insured losses from the floods. On the life side, if we look at the high net worth flow into UAE, and literally like there's, if you open LinkedIn, there is a message every other post that millionaires moving into Dubai from different parts of the world. So a lot of millionaires are shifting into Dubai. The current penetration from a life perspective is low. So there is a lot of potential seemingly on the life side for the growth of business in the UAE. Aman will touch upon that, but I feel that personally moving to the long-term residency, the defined contribution, pension products and all those things coming in will bolster the life insurance industry as a whole. I'll come back to this later, but just to cover one last point about digitalization. So the digital footprint in the UAE, like 85% people have bank accounts, 75% make online payments, 64% do online shopping. I personally probably do 2 online shoppings a day. So a lot of people are using digital and online platforms in the UAE, but has that translated into insurance? I'll just come back to this. I wanted to show this. Okay, so this is basically from the CBUE and the IA report in Saudi. They are on similar scale. So you can see that the online sales in Saudi are really high. The aggregator business has picked up in Saudi a lot. The numbers in UAE, again, this comes from CBUE and they pick it from the e-form, so probably is also based on how people classify online. But the UAE numbers are very negligible and the Saudi numbers are large. This, as Hatim was saying, actually can be a blessing in disguise because Saudi business through aggregators, they're actually struggling and there are huge losses that they're facing, especially on the motor side. I think the losses in Saudi on the motor side are close to 1 billion for this year. So maybe a blessing in disguise, but yes, the online sale itself, like if you look at this breakup, the Saudi numbers are like almost 15%, while the UAE is almost non-existent. So this was one thing which I did want to highlight. Now, if I come back to, just this one. One other thing which I wanted to mention, that from a professional point of view, we feel that LinkedIn is like obviously one of the best platforms, but you need to, as insurance companies, when you're advertising your products, you need to understand which platform the user is on. And if you look at this Facebook, TikTok, YouTube, Facebook Messenger, people spend much more hours on that. So as an insurance company, should we have more visibility on these platforms? Because this is where the end user is spending more time on. Time spent on LinkedIn obviously is much lower. So this is also something that companies may consider. And if I just go back to this, Mirza, if you can. So as always, we will ask you guys to participate. There is a question there's actually a couple of questions. I just want your view on what you feel will drive the insurance industry in the next 5 years and what will be the inhibitors that will restrict the growth of insurance in the next few years. If you can just log on and spend a couple of minutes on that. So firstly, what are the tailwinds that can drive insurance sector growth? Okay, so better regulations, customer service. Customer service is actually something that a lot of people don't really concentrate on. That's a very important aspect. Population increase obviously will drive insurance growth a lot. Life insurance, that is my expectation also personally. Digital, absolutely. Regulations again. AI. Competitive pricing, that is again a wish. Regulations, digitalization, tighter commission regulations. Okay, I thought that BOD 49 had actually counted that. New blood. Yeah, demographic changes, increase in population, all of that will helps to spur the insurance business, that is for sure. Infrastructure projects will obviously do that as well. Okay, this is good. Mirza, you can switch to the next one. Okay, so now what will adversely impact the growth of insurance in UAE? Chinese card. Geopolitical situation is obviously something that is a systematic risk for this region. Nat Cat is a risk too. Low premiums and the competitiveness of prices, definitely. Absence of large retiree base, that is true, but now with the long-term residency and all, that population shift will hopefully be visible in the next few years. Provider tariff utilization, price wars, recession. Cat events again, so that is there. Claims fraud, okay, that is another very valid point. A lot of companies suffer from fraud and measures need to be put in place to counter that as much as possible. Adapting technology or lack of adapting technology, yes, that will definitely be a headwind as well. Rising claims and inflation, true. Insurers with weak solvency, that is a good point that you've brought this up, because that is a concern that we also have. The CBUE has recently tried to become more proactive on this, stopping companies from writing business in one case also, but more action needs to be done for companies that are currently struggling with insolvency. I agree with that. Credit risk, okay, another very, very good point. There is a huge credit that is circulating in this market, and when that comes from insolvent companies, that becomes a much more significant risk. So, yes. Inadequate risk management, Motor recovery is again the same point. Okay, in the interest of time, I'll stop here. Thank you once again. And we have like sessions individually on motor, health, and life. They'll delve further into details of these. But thank you all, and thanks a lot.